Welcome to you to this month's edition of the Biznews Champions Portfolio webinar. I'm in London. Alec Hogg is my name. And of course, as always, in Johannesburg is my colleague, our managing editor, Stuart Lohman.
Yes, thanks, Alec. Good to be here again for another monthly update.
And Stuart, just take us through the hand putting up stories and to make sure that everybody can hear us okay.
No, thanks, Alec. Yes, if there's a little, there we go. I've already got some hands coming. Darren says he can't hear very well, Alec. I'm not sure if you want to lift the voice. It seems fine on my side, but Darren says he can't hear you. So maybe just lift it a bit.
Okay, let's see if that helps you a little bit more, Darren. I have a microphone next to me here, which should be picking everything up fine. But everybody, let's just see how those hands have been raised.
Alec, I've got another one. So I can hear Stuart fine. I just can't hear Alec very well. That's from Kieran.
All right, Kieran, I'll tell you what I'm going to do. Once we move over to the presentation, I'll be talking. You see, if I do that now, while I'm on your web screen, it looks a bit strange, doesn't it? But I'll move on to as soon as we move on to the presentation, I'll make sure that I bring that microphone a lot closer. That should be a bit easier then. Anyway, just to welcome you to this, and we do have this webinar every month. Stuart, just give us an indication of how we work with the questions.
Thanks, Alex. So there's a little question tab on the right-hand control panel. If you drop down that menu, just slot them in there, and I'll pass them on to Alec as he goes through the discussion. So just put them in there, not to worry, I'll deal with that and pass on to Alec and get some answers.
Great, and let's just double check now that as far as the technicals are concerned, everything's working well. Are you seeing the big screen there, Stu?
No, sorry, Alec, it's in PowerPoint mode, it's not full screen.
Okay, how's that now?
No, it's still PowerPoint. There we go, 100%. We can rock and roll. Yeah.
I hope I haven't messed it up now. I just fiddled a little bit more. All good, everybody happy. Fabulous. Well, it's another very interesting period that we've had here in the last month. Okay, we should be good now. Stuart, just as far as the sound is concerned, is that any better?
Much better, thanks, Alec.
Perfect. What I do is take you through through a slide presentation, and then we can stop at any time, and Stuart will jump in to ask various questions. I see there are already 5 questions that are up there, but please feel free, keep going, because this time we'll try and get through all of the questions. The rationale for this portfolio is, as it is on the screen there, a hedge against the rand by investing in South Africa's global champion companies driven by its best entrepreneurs. So what this means is, on the one hand, we're trying to offset the decline in the value of the rand. We believe the rand will fall because of poor economic management of the South African economy. And the way that we are wanting to hedge ourselves against that, in other words, protect ourselves against that, is by investing in shares listed on the JSE, run by South Africans in the international arena. So a company like Capitec, for instance, which I love, is not in this portfolio for the simple reason that Capitec does not have an international presence, or not much of an international presence. These have got to be global champions. Discovery is in the portfolio, and the major reason for that is that Discovery has got a substantial operation in the UK and, of course, elsewhere in the world. But its main business is still in South Africa. However, it's expanding aggressively into the global community. So just to remind you of the strategy that we have on this portfolio. The main thing then, given what the overall strategy is, it's a rand hedge. And the rand has not assisted us at all. As you can see, when we launched the portfolio on the 23rd of January, the rand was at 12.92 against the US dollar. Today, it's 12.93 against the US dollar. So the strategy of the portfolio is to hedge against a decline in the rand. As it's happened over the period, over the 9 months that we've had this portfolio running, the rand has, at this point, not done anything. It has not misbehaved at all. So as a consequence of that, we've had no uplift from the value of the rand declining. It's been volatile, as you can see there. In February, the rand strengthened all the way to below 12.50 to the US dollar. And then shortly afterwards, it got to nearly 14 against the US dollar. In the last month or so, as you can see pretty clearly there, it has been strengthening quite significantly from 13.50 all the way down to under 13 Rand. So the past month has not been supportive of the portfolio as far as the Rand the Rand's behavior is concerned. But let's have a look at the portfolio itself and see exactly how it has performed over this period. One last thing before we go into the indication of the individual stocks. What we did do, although we invested 100,000 Rand, or in fact I put more than 100,000 Rand into my Easy Equities account, but you can put your 100,000 Rand or more, or multiples thereof, into the Easy Equities. It's called a bundle, so you get exactly the same replica here. There have been two changes that we've made since the investment started on the 23rd of January. Both of those were for significant reasons. The intention of this portfolio is every single stock that is bought is held indefinitely, but in certain cases where we see things happening that will affect the underlying business, then we will make a change. And we did this with Blue Label. We sold those shares at 17 Rand and 8 cents on the 4th of May and switched it into Naspers. Now, there was a couple of reasons for this. Naspers accounts for 25% of the SWIX index, the South African investments in JSE-listed shares. 25%, that's how important it is now in that index. Or 20% if you just look at the overall index. And we only had 8% in Naspers as a start. It's one of my favorite shares in the whole world. In fact, in our global portfolio, the Biznews global portfolio, we have Tencent, which is really the major reason why Naspers has done so well, the Hong Kong listed share Tencent. We have that in that portfolio. So when you restrict it just to the JSE, obviously you go big on Naspers. We only had 8% of the portfolio in Naspers, so that was an oversight, which we corrected that on the 4th of May. The other reason why we sold out of Blue Label, we were concerned about the contamination effect of Net1, which was getting into all kinds of trouble over its SASO contracts. The Blue Label and Net1 were busy doing a deal. In fact, they are now partners in Cell C, and that also was a huge investment by Blue Label, which focuses it more in South Africa rather than its external operations in Mexico and India. So we felt that on both scores, Blue Label becoming more South African focused and Naspers being underweight, it was a good idea to make that switch. The result has been quite good. Since that switch was made, Naspers' share price is up 17%, Blue Label's share price is up 7%. So we have it has benefited the portfolio. The second decision was one based on a view that Wilson Bailey was hitting some pretty tough wins in the South African market. It wasn't doing great in its Australian business either. So we decided to sell out of that and to switch it into Glencore, which has subsequently justified that decision. We'll talk more about Glencore in a moment, or rather later in the presentation. Glencore's share price is up by 33% since the 1st of June, whereas Wilson Bailey's is up by 4%. So we are in a situation where we can look back on those switches and say, certainly at this stage, that they were well justified. And there's the overall portfolio, and it really is an interesting portfolio to look at. In the past month, it's risen by 500 Rand, as you can see, underperforming the JSE All Share Index at this stage. That is not surprising, given that we have a view, this has all been built on a Rand hedge. So underperforming the JSE All Share Index is really not it's not surprising to see it if the Rand isn't performing the way that we think it will, because clearly we're heavily Rand hedge focused, whereas the JSE is not anywhere near as much. However, you've seen some very good performances by three of the stocks. Naspers, which continued in this month, it and Glencore rose further, both of those adding to the portfolio. On the downside, we had another decline in the share price of Brait, and we had that shock that hit Steinhoff, which is now 10% below the price at which we bought in at. So both Steinhoff and Brait in this past month were underperformers in our portfolio. As far as the overall is concerned, that 6,000 Rand gain after costs has come roughly through Discovery. In fact, has been the best performer in nominal terms. That's given us 3.5 3,000 Rand profit, Naspers 3,000 Rand profit, and Glencore 2,500 Rand profit. Against that, the big loser has been Brait, which has lost us 4,000 Rand. So your 6,000 is, well, it's a bit of a fiddle between the rest, but there is, or fiddle around between the rest, but Naspers, Discovery, and Glencore have been the three big beneficiaries for us.
Thanks, Alec. Just to jump in quickly, sorry. On changes, Thomas wants to know if you've ever considered Mondi. He says they've had pretty solid returns over the last 8 years and operate internationally in Central Europe and Russia. What are your thoughts?
Thomas, I'll let you in on a little family secret here. My cousin, who's a chartered accountant, is married to the ex-CEO of Mondi. So it is a company that I've watched very closely for that reason. It's a good business. When I put the portfolio together, it was overvalued relative to what we were looking for from a intrinsic value. I did all the numbers. I ran them out. It's a really good business, and we can expect, David Hawthorne has left a great legacy there. We can expect it to continue to flourish in the future. But my problem there was that it was overvalued relative to the other stocks that we put in the portfolio at that stage. But thanks for the reminder. We'll have another look at that Mondi now.
Thanks, Alec.
Stuart, do you have any more questions?
No, Alec, all the other ones were on the sound issue at the start of the broadcast. So that's the first question.
We're now on the sound. That's fantastic. Let's move on. There's Naspers' share price. And that, as you can see, has been a really good performer in the last year. It's been up, well, it's been our best performing stock in the portfolio. As that 298 was the share price as of this morning, so it's getting close to an all-time high. Stuart, I just need to attend to something outside here. It's quite funny when you do work from home. We've got a okay, things seem to have settled down now for a minute. I was going to ask you to talk a little bit more about Naspers, but I guess you're off the hook there. Let me just give you some insights on what happened in the last month. You will recall that there was an annual general meeting at which some of the shareholders in Naspers were unhappy at the remuneration that was being paid to Bob van Dijk, the chief executive. There's also concerns around Naspers' ownership structure, but my view on this is very clear. In the media industry, and it is the one industry that I know better than any other, having run a public and listed a public media company, and obviously running and one now in both MoneyWeb before and Biznews now, you need to be able to take long-term bets, long-term decisions. I'll give you an example of what we did at MoneyWeb when we moved our radio show away from Classic FM to the SABC. In the short term, it caused an enormous amount of problems for the business. It hurt us from a immediate impact, a profitable impact, but in the long term, it was a wonderful decision. However, if you're just operating a business for quarteritis or every quarter, and if you have shareholders who jump on your heads, fortunately MoneyWeb was too small for the shareholders really to worry too much, and at that stage I controlled the company myself. So I could explain to myself, if to nobody else, why that decision was taken. But the shareholders sometimes like to be driven by short-term views. And with Naspers, there is an inclination of shareholders to say, but why is Naspers trading at a 30% discount to its ownership of Tencent shares alone, let alone all the other investments that it's made around the world? So short-term driven shareholders, and particularly share activists, would, if they had the opportunity, would force the managers of Naspers to sell the Tencent shares. Now, if you've done that any time in the last 20 years, if these activists had had their way and forced the sale of Tencent, all of Naspers shareholders would have been far, far worse off today. Tencent has continued to flourish and likely to continue so into the future. It has an amazing franchise, 900 million people who use the app as their primary entry onto their cell phones in China. and it's now starting to move into other areas of the world as well. So had Naspers been forced, had its managers been forced by short-term profit-driven shareholders or traders to make that kind of a transaction, well, then we would have had a much poorer company. And it's like this in many media businesses. If you have a look at Google, for instance, it's got two classes of shares. The founders, Sergey Brin and Larry Page, and the chairman, Eric Schmidt, have between them got about 60% of the voting shares, but a far smaller percentage of the economic interest. It's a similar story with Facebook, where the founder, Mark Zuckerberg, has got high voting shares, and he retains control of the votes in the company, even though his economic interest is much lower. And part of Naspers's success, in my opinion, being in this industry and having sat in a far, far smaller seat, but having sat in the same position, is that the company, by having the current ownership structure of the company, gives the managers or the owners the ability to take long-term decisions. Now, in Naspers, they've got Naspel and Kieromstraat, two vehicles which control over 50% of the voting rights of the company. So that's why the N shares, the Naspers N shares, are the ones that are listed. So the voting rights of over 50% are unlisted. The listed shares have less than 50% of the vote. As a consequence of this, Naspers's managers can be independent. They know there's continuity. They know they can take long-term decisions. They know they don't have to listen to activist shareholders who are trying to get them to sell Tencent, which would have been a disaster. And also, more than anything else, perhaps, given how important Tencent is in the lives of Naspers, they are satisfying the Chinese government, who've got some pretty prickly views on media ownership, because in this ownership structure, Naspers can never be the subject of a hostile takeover. And let me tell you, when you spend decades, as they have, in building a business like this, there's nothing worse than finding one day you wake up and somebody else owns the control of your company, and all the hard work that you've put in has been taken away by people who either don't really know what they're doing or are looking for a short-term benefit. So as long as Naspers has its current ownership structure, you should be happy to be invested in this company. I know that it's not a popular view at the moment. Some shareholders are saying they want to make the decisions. Well, if they want to make the decisions, it's pretty simple in my view. Don't buy the shares. If you don't like the way that the company has been run, and this has been one of the most spectacularly well-managed businesses on earth, let alone in South Africa, then just sell the shares and go and find yourself something else. But as far as media companies are concerned, you see it with Google and Facebook. You also see it to a degree with the Murdochs in their news corporation. Media companies need long-term decisions. You need to make long-term, you need to think long-term and not worry about the short-term vacillations in market sentiment. Moving on to Mediclinic. This is the company that also you have to look at long-term. As you can see from Mediclinic, this is a one-year graph. It's really been a pedestrian business for most of the last year. We had that little uptick in May, which this is in Rand terms. Remember, it is a FTSE 100 company, so it's listed also on the London Stock Exchange, but it's been bouncing around about just over 120 Rand a share. This is a stock that is going to move very quickly when the pound starts appreciating against the Rand, which is, if you have a look at, you talk to most analysts around the world, and they will tell you that the most undervalued currency on earth today is the British pound. And the South African Rand is significantly overvalued against the pound. Even those who believe that the Rand has got some scope to rise against the US dollar or the euro will tell you that don't bet against the pound, though. So as Mediclinic is listed in London, that's where the share price is made. The company, underlying business of the company, very strong. They've invested in Switzerland and in the Middle East. But I'm quite confident that we're going to see a good return from this one. You just got to be patient, as one has to do in any type of investing. Here's our big problem. Not Christo Visa. but our problem in the portfolio is Brait. And Brait, as you can see, it has come down a long way in the last year. And in fact, if you go back a little bit longer, you'll see that it's fallen even further. So we're at a price now at below 60 Rand a share for Brait. And Brait itself has been piling into the stock, doing share buybacks at in the mid-60s. So even the managers are now shaking their heads and thinking, what the heck is going on here? The reason why Brait has fallen out of favor is its biggest acquisition. Well, let me just go back a little. Brait had it had the good fortune to be used as the vehicle for Christo Visa's private interests. So what Visa did was he injected into Brait the shareholding that he had in PEP, or a big chunk of the shareholding in PEP. So when PEP did the deal, the merger in 2015 with Steinhoff, that gave Brait a massive uplift. It also gave it a huge amount of cash, and clearly Mr. Visa had been eyeing out some opportunities in the UK. He'd already been represented there with quite a few businesses, but one of the businesses that he was particularly taken by was a company called New Look. Well, it wasn't the smartest move, as it turns out, because they bought into New Look at a price that is substantially higher than the current value. New Look's fortunes have really gone the wrong way in the last year, or since the acquisition on the by Brait on the 26th of June, when it bought 81% of the company. And the consequence of this has been that Brait has now refocused its attention on New Look to try and find out how it can turn this around. Brait really is, if you like, it's four businesses. It's got New Look, which was the biggest part of the business, but it's been written down substantially. It's got Virgin Active, which is primarily in the UK. It's got Iceland, or 57% of Iceland, which is also in the UK. That's a very successful franchise. Iceland provides frozen meals essentially to the UK market. And then it has, in South Africa, it has the old Premier Milling, which you probably remember quite well. Now, 3 of the 4 cylinders are firing really nicely, but New Look has been a disaster. And as a consequence of that, the impact of that on the portfolio, on our portfolio overall, as well as more particularly on Brait's valuation, has been significant. This month, at the beginning of this month, Brait took another step in fixing New Look, where it got rid of the chief executive, Anders Christensen, who'd been there for 5 years. He's a Dane. He was appointed in 2012 by Apex Partners, the private equity firm that sold New Look, which is a retailing firm, which was very, very strong in women's wear. Has about 3.5% of the UK women's wear market. But under Anders Christensen, it went into China, where he has experience. It's built 100 stores there, and it started creating standalone menswear shops. Neither of those have worked out. China is still not profitable at the moment, and the menswear shop hasn't done well. The UK market is one where there's huge competition in this field, in the clothing field, and costs are rising higher than revenues are rising. So after the results came out for the year to March, which showed that New Look had lost £16 million on turnover of £1.4 billion, the writing was pretty much on the wall for Christensen, and he finally left the company at the beginning of September, after a 5th successive quarter of falling sales. What happens next? Well, they're going to have to find themselves a replacement. Visa's pretty good at this, as you can see from his track record over the years. He's been able to spot the right kind of talent. They have put Danny Barroso, who's the MD of the Ireland and UK operations, in as the interim chief executive of New Look, but they have also said that New Look will be looking around for a New Look CEO. So yet another step in a turnaround of this business, and it's really, that's the swing factor. Since the latest results came out, we saw a further decline in the share price to below 60 Rand. It's kind of lifting its head in the last few days. I would like to believe that the worst is over, and indeed, when you talk to the investment analysts over here in the UK, they say that whoever comes in as the next CEO of New Look is actually going to be given quite a nice bit of runway, because there's been huge investments in the infrastructure. They've got a good online presence, which is very important in this market, and that the CEO will be able to cut back on capex, drive sales. Also, they've got plenty of liquidity. The bonds that they've issued are only coming due in 2022. So you've got 5 more years before they have to worry about their liquidity or going back to bondholders to reissue or roll over new bonds. In that time, one would anticipate that New Look would come right. The rest of Breit's assets are going well, so I'm quite happy. I'm happy to have the stocks. I did write about it a little while ago, and in fact, one of our premium subscribers asked me whether he should put all his money into Breit. I'm so glad that the response was no. That's never a wise idea. Rather spread it around the portfolio. But by the same token, I'm quite happy that we've got Breit in the portfolio at the level that we have, around about 11%. It started at 15, so it can just show you, unfortunately, what happens when you start losing money in a stock, or when a stock goes backwards. But this is a long-term portfolio, and I'm quite comfortable to be invested there as well. While we look at the picture of Adrian Gore, Stuart, you must just interrupt me if there are any more questions.
Thanks, Alec. Unfortunately, you can hear crickets in the question room. There's nothing through yet, but I do encourage people, please, anything that comes to mind. As I said, there's no silly question, so just pop them in, then I'll pass one to Alec as soon as they're there. So please do.
Yeah, and it's a good idea if you can send your questions through. The reason for that being that we tend to get many questions towards the end, and then we're unable to answer them. So far better if we can get onto those early enough. Here's Discovery, and Discovery brought a trading statement out this month. It was a very positive trading statement, one where the headline earnings for the year to end June are going to be up between 18 and 22%. I'm going to be watching the financial results, which comes out on the 18th of September, that's next Monday, to make sure that they're still on track. Well, there isn't really much you have to worry about on the profit line, because headline earnings, call it 20% up in a year, is fantastic. The big move is probably happening in the UK, where there's been enormous investment there. They say the difference between earnings per share, which are going to be up about 10%, and headline earnings per share, which are up 20%, is because there was significant investment, one-off investment last year in the UK, which of course that has an impact on headline earnings per share, but not on the earnings. Don't ask me why, that's what the accountants tell us. The reason, so the UK, we can see it, if you live here and you have a look at the Vitality brand, particularly now during the football season, it gets enormous coverage. And with every day that passes, the national health system seems to creak a little bit more. So there is a opportunity, or the opportunity for private healthcare insurers, like Vitality is, and that's a wholly owned subsidiary of Discovery, seem to brighten up just a little bit more. If you recall, Warren Buffett said the way to business success is to widen your moat every day by doing just something, just a tiny little thing, to make your customers happier. And that's what Discovery is doing in South Africa, and certainly is doing in the UK with Vitality, where its future is going to be. There are lots of other businesses around the world, and there's no doubt that they are also going to be playing their part in future. But the one that we keep an eye on now, for the moment, is the UK business, particularly as far as the SA Champions portfolio is concerned. The other big story for Discovery is the banking license that was granted from the Registrar of Banks is allowing them to move into the banking field next year. And I've got to believe that banking stocks are in South Africa are the big banks anyway, are very, very questionable at the moment. Look, they're sitting on low PEs, but we see what Capitec has been doing to them. And with Discovery coming into this market, there has to be further pressure on the prices of the South African banks. Discovery has been an excellent disruptor in every field that it's gone into. Its original field was going into healthcare, where it completely disrupted the market. In the insurance field, or motor vehicle insurance field, Discovery Insure is doing the same thing. And when it goes into banking, it's not going there just to keep the executives occupied. You can be sure there'll be a very modern, high-end banking offering, which is going to hit the big banks or the traditional big banks in South Africa at the top end, whereas Capitec has been hitting them at the bottom. And neither of those competitors are going to be stepping back against the incumbents. So I would be a little concerned if I was invested heavily in South African banking shares. Incidentally, there was another bit of news coming out of the Big Four, well, the old Big Four, because Capitec has now replaced Nedbank as number 4, by market cap anyway, was that at Standard Bank, the joint CEO positions between Ben Kruger and Sim Shabalala have now been changed. Ben has stepped down as joint CEO with immediate effect. You wonder why? Well, it was immediate effect. And Sim will now be the sole CEO. Ben Kruger is staying on with the bank. He's not leaving. He's staying on as the as an executive director of the company. So they're playing their taking their bets and at Standard Bank, but there's an enormous amount that they're going to have to do to get themselves ready for the challenge that'll be coming from Discovery, as will the other banks as well. Interesting times in South Africa.
Thanks, Alec. George wants to just a quick thing on Naspers. He's a bit concerned about the Chinese government investigations. I think it's on the subversive content, and before that was the online games. Do you think this will affect the price and therefore Naspers' share price?
George, you never really know with China, but what we do know is that Pony Ma, who's the chief executive of Tencent, is a past master in dealing with the Chinese government. They are an enormously powerful business, and it appears as though, well, enormously powerful with 900 million Chinese who use the WeChat app in the same way as in the Western world. If you have an Apple phone, you charge up iOS, or if you have an Android phone, you'll charge up the Google written software operating system. Windows on those has its own market share as well. But when you look in China, everybody works through this, or most people work through this WeChat, which then gives Pony Ma's business a very, very strong positioning. But they don't push it. It's almost like they deal with the government in a deeply respectful manner within the cultural environment that works for them and works for the government. And from time to time, there are going to be issues that are raised. If you have a look at what happened with the share price of Tencent when that problem was flagged by the Chinese government, share price came back for a couple of days and then just carried on steaming ahead as investors saw it as very much almost a warning shot, or just be sure that you don't overstep the mark kind of message, rather than anything that's going to affect the underlying business. Remember, China being the second biggest economy on earth, whereas it sits with 4 times as many people as Americans, which suggests that at some point in time it should have 4 times the size of the economy, and it's still only about half the size of the American economy. So it's got a long, long way to go. But China is wanting to do that by creating its own global champions. And one of the global champions is Tencent. So it's most unlikely, just about, well, you can never say never, but very, very unlikely that the Chinese government would smash one of its own champions or potential champions. And that's very much where Tencent is. By contrast, we are likely to see Tencent move into Western markets. It's already moving into Africa, taking on WhatsApp in Africa quite aggressively. And we could expect it to learn from its mistakes. It hasn't been too successful at this point, and to then move into the Western markets. So that's more likely, and the Chinese government would be delighted to see one of its champions succeed in areas where at the moment the Chinese companies haven't been that successful. So yes, you've got to keep an eye on it, but the bigger picture would be one of supporting Tencent, I would say, rather than putting it out of business.
Thanks, Alec. A question from Graham. You might have touched on it with Brad. He says, is there any share strategy in which to take advantage of the low British pound exchange rates?
Brad is one. Another one is, in fact, through the various trading operations, you can you can buy the British pound directly if you feel that way. I always worry about that because the British pound has been undervalued now for, well, ever since Brexit, and that's over a year. My thinking is rather go for a longer term bet and invest in these companies that we've got in the portfolio that are very focused in Britain. And there you've got Investec as one, the one on the screen now, got a huge franchise in the UK. Brait is another, and Discovery is another, just for starters. Just to put it into context, I was doing the numbers the other day. South Africa and the UK have roughly the same number of people, around about 60 million. South Africa is 56 and the UK is about 60. But the economy, the GDP per capita, in other words, you take the economy and you divide it up by the number of people, in South Africa is $5,000, in the UK is $30,000. So you've got an economy which is 6 times bigger. Sorry, it's 40,000. It's 8 times bigger in the UK than it is in South Africa. And as a consequence of that, if you can get it right in this much bigger market, of course, it's because it's bigger, it's potentially a lot more competitive. But if you have a business that's outgrown or hit its limit in South Africa and is able to take a chunk of the UK market, then clearly you're betting on a horse that's got a lot more in the tank. The other thing is that if you're able to buy in at lower rands, at a lower price now, which is effectively what you're doing by buying the shares on the JSE, then that would make a lot of sense. The obvious alternative to that is to invest directly in British companies in British pounds, or to invest in the FTSE 100, perhaps, if you're looking for an ETF. But either way, it's pretty well known that the pound is undervalued at the moment because of the concerns around Brexit. That's not going to last indefinitely.
Thanks, Alec. I've got a question from Margaret, and I think you've touched on it quite extensively with David, and there's been a lot on the website around it. She says, Bitcoin, talk to me, Alec.
You know, David Shapiro is starting to panic because he says it reminds him so much of what's happened during the past bubbles. For me, I've lived through the 1987 crash, and just as an aside, back then I was this young guy who thought he knew a bit about technical analysis. I had Auntie Jean Moon, who was a technical analyst back in those days. In fact, she's very good. She's written a couple of books on it. And I would plot the charts. And anyway, I was working with a company that we subsequently bought at MoneyWeb called Presscon Publishing. And we brought out a weekly newsletter called Capital Gains that people in those days paid 1,000 Rand a year for. And it was all about share tips. So we'd have, on technical analysis, maybe 4 or 5 shares in this little newsletter that people would then read this because they were looking for share tips everywhere. But I'll take it one step further. Back in those days, in '87, there wasn't the internet. The distribution of information was very, very different to what it is today. And we used to have a phone line, I kid you not, that people would phone in on the morning. They would subscribe. Again, it cost 1,000 Rand a month. Martin Springs certainly knew how to charge his market. He was the CEO and the founder of that company. And at 1,000 Rand a month, it would give them the right to phone in the morning, and we would then tell them, there would be a recording which would tell them what the share tips of the day were and what the technicals had said on them. That is the kind of extreme situation that you see in bubbles, in stock market bubbles. I've seen that one in '87. It was absolutely crazy. I saw it. I remember as well in '87 that Sanlam came out with an analysis to show that if you were to take inflation out of the equation, that the share prices in 1987 were actually no higher than they were in 1969. And 1969 was the previous big crash. So what this is telling us is two things. One, when everybody is tipping and they don't care anything about it in analysis, they just want to get part of the action. They want to buy stocks to make money, to pass on to a greater fool. That is when you need to worry about it. And the second point is that when people start justifying the unjustifiable or defending the indefensible, that's when you need to worry as well. The point David Shapiro makes was in 1929, which was the biggest crash that the world has seen. Joe Kennedy, the patriarch of the Kennedy family, the family that gave us JFK, the president, and Bobby Kennedy, would probably have been the next president had he not been assassinated. He, in 1929, was on his way to work at the stock exchange, and he stopped at the shoe shiner, and the shoe shine boy gave him a tip on a share, and he said, whoa, when the shoe shiner is telling me what I should be buying on the stock market, then the public has taken over. Then it's become a casino. He sold all his shares, and the Kennedy fortunes were made. He obviously missed the crash that came not long afterwards. David says when he looks at Bitcoin, it gives him all the gut feel of a bubble. When I look at it, I think that it reminds me a lot of the internet bubble or the NASDAQ bubble in the year 2000, when, of course, things will be different, and we know that the internet will change everything. The only problem is that markets tend to exaggerate things in the short term and then underestimate in the long term. So if I extrapolate what happened with the NASDAQ in 2000, when it, if you recall, it went through the roof and then, of course, fell down just as quickly. If you overlay that onto Bitcoin, you'd now be looking at a situation where, sure, you might get in there today and double your money, but the likelihood, the greater likelihood, is that the market will collapse before it then goes back and has a nice long-term trend. So for me, if I was going back in a time machine to the NASDAQ bubble, I would not have bought Amazon.com just before the bubble burst, where the share price was 1/10 of where it is today. But in fact, it collapsed by 97%. It's hard to believe this, that with the NASDAQ bubble, Amazon went down 97% before it then started growing again. And it grew up to a point where it is today 10 times what it was at the peak before the bubble. So I guess if you're going to buy Bitcoin now and you're going to forget about it for 20 years, you might sit with something that's worth 20 times or 10 times in its value in 20 years. But it's likely to be, there's something is likely to happen to us between now and then. And my suggestion to you would be that it looks like a bubble, it smells like a bubble, or they say if it looks like a dog and walks like a dog, it probably is a dog, and that would be the right way to do this one.
Thanks, Alec. I think it might be more for Easy Equities. A question from Graham. He says, with them opening up the US dollar account, does it change the structure of your portfolio to include some of this direct US dollar investment? But I think that would be covered with the global investing portfolio.
Yeah, it's a good question. As far as we're concerned here, this is the SA Champions portfolio. It's 4 investments on the JSE, and it's all through Easy as well. We actually are talking to Easy about putting together a bundle on US shares, which will be very similar to our global investment portfolio. So it's likely to be similar, but no, not for this portfolio. This is very specific. It's Rand hedges, South African champions, South African run companies in the global arena.
Thanks, Alec. That's it for now.
On to Investec. It's been steady, as you can see from the share price graph there. Investec hasn't really had a whole lot happening in the last month. We will be looking forward to maybe breaking out of that channel that it's been in for a while. But I can see how well Investec is doing here in the UK. In every single scale, you see the guys getting quoted in the newspapers, or online. You see the adverts. You see them. The presence of Investec is significant in the UK. And when the pound gets back to its rightful level, Investec's share price will definitely benefit. At the moment, it is being held down by the undervaluation of its UK assets. Steinhoff had a very turbulent past month. We've known for a while what's been going on with an investigation. It was quite a funny story, this. just before Steinhoff listed in Frankfurt, there was in fact, it was in the week before the listing. So can you imagine this? You're putting the whole company together. It's the most exciting time probably in your life. Your primary listing is going to be on the Frankfurt Stock Exchange, an international stock exchange, the biggest listing of that particular year. It was back in 2015. And the week before you list, there is an investigation from the tax authorities. Talk about somebody peeing on your parade. Well, that's happened again in the past month. We've had an article in Manager magazine where they warmed up the old soup, and they said that there were problems with the accounts, illegal accounts or illegal entries into Steinhoff's accounts, and they suspect accounting fraud. That's what the magazine wrote. Steinhoff came back and said they've had an external auditor who's come in, had a look at this after what occurred a couple of years ago on the week of their listing, had a look at this, and they've found that the external auditor has found that there's been absolutely no law violated, that the allegation is that the subsidiaries between themselves were doing transactions that they inflated. Now, I don't know what the benefit of that would be. An accountant would be able to tell us that, but that's the big allegation, that there's been fraud because they've inflated the value of transactions between subsidiaries. Steinhoff says external auditor came in and said there was no problem. What they do say, though, is that they're busy with litigation with a guy who was a former partner of theirs in a joint venture. And that litigation, although it's not going to be material to the Steinhoff company, is bringing up some ugliness. And they accuse this partner of, and I'm going to quote this to you, abusing the press as part of the process of litigation. So when you step away from this, it just looks too suspicious, doesn't it? The timing of these articles, the timing of the investigation from the tax authorities. And incidentally, Steinhoff says that they've been engaging with the tax authorities since that day of the raid or the allegations made of the week ahead of its listing in Frankfurt. And there's been no more, nothing more to report, that nothing more has happened. But it does appear as though the backstory here is they're in litigation with somebody. This person has threatened to besmirch their name. They've said we don't give in to blackmail, and Steinhoff has continued in its business. And this guy every now and then finds some willing journalist to run a story which alleges that Steinhoff is doing things wrong. You'll see the share price went all the way down, dropped 10% on that magazine article in Germany, but it has recovered much of that. It's still a long-term bet for us, Steinhoff. We like what's happening around the world. I really like what Sean Summers is busy doing with Mattress Firm in the US. This month rather, was also the announcement that Steinhoff is going to be hiving off its African assets and listing it in a company with a really lovely name called Star, which will be Steinhoff Africa, and it's likely to be reinstating the deal that had been spoken about with a merger with Shoprite, because Steinhoff now has secured an option to buy the controlling shares in Shoprite from Christo Visa. So all of this is happening on the one side. They will be listing Star or Steinhoff Africa before the end of September. That will mean Steinhoff International will be free of any African assets, and the African discount is likely to go, which will then give Steinhoff International, will bring it onto the radar screens of investors who are not that keen on Africa, and a consequence of that is likely to be a re-rating of the Steinhoff share. So we're very happy to be sitting with Steinhoff, and having known Marcus Jooste for many years, I'm pretty sure that there's what he tells us about what has happened with the allegations of tax fraud or accounting fraud is exactly the story as he has outlined it.
Thanks, Alec. Just on Star, Alan, I think just follows up on what you're saying now. He says, how does it affect the actual price of Steinhoff in your view, and do you recommend applying for the Star stock itself?
Not in this portfolio. in fact, what is good for us is that STAR will mean that Steinhoff then becomes even more of a global champion. So it'll take its South African assets right out. You can, as things stand right now, you'll probably find that the STAR plus the Steinhoff International share price will add up to the current share price. So we're trading around, there we go, 64.50. You are likely to see that STAR, for argument's sake, is 20 Rand. And then you would find the other part of Steinhoff will be 44 Rand 50. So they'll take a while to sort themselves out. But what tends to happen is that the market would calculate what it thinks the two parts are worth. Remember, there are some very well-paid, very intelligent investment analysts whose only job is to check these kind of things and to make sure that they don't get the weightings too wrong. But where I'll be excited is that once we get to, say, 44.50 for Steinhoff International, we would then sell our STAR shares, the South African shares, reinvest that in Steinhoff International. So we would then sell the 20 Rand, and then we'll go back to put it into Steinhoff International. So we'll be sitting there at the 64.50, and that would give us 100% of a global champion, 100% offshore. So that when, remember, our play here is that we think the Rand will weaken. So when the Rand weakens, you get 100% of the benefit rather than 80% as you would be getting at the moment. That's what we'll be doing in this portfolio when that transaction is done. But sometimes when there's a spin-off, it does lift the share price, or the whole, the two parts sometimes are worth a lot more than the whole. There's a wonderful example of this was when Iscor, the old iron and steel company that was once government owned, when that split into ArcelorMittal, well, what is now ArcelorMittal, and Kumba. If you'd kept the two separates, you would have made a lot of money, and it was worth a whole lot more than the individual, than the combined unit. Moving on to Glencore, there's an article that came out in August, which is one that I urge you to read. The Economist has got a good opportunity for people to have a look at the publication before they actually subscribe. And if you look at this, if you read this article and you aren't convinced that Glencore is a fantastic investment opportunity, then I don't think you ever will be. You might remember that we bought into Glencore after the AGM, where Ivan Glasenberg, the chief executive, made the case for Glencore being a pick and shovel, or the provider of the pick and shovels for the electric car boom. That's essentially what he was saying. And the reason for that was that Glencore is #1 producer of cobalt, #1 producer of copper, and #3 producer of nickel in the world. What I'd like to remind you of is that at the moment, well, copper production is 20 million tons. Glasenberg took a view that 95% of cars that are being produced in 2035, so he took it out to 2035, 95% of the cars then produced will be electric cars. And it's not surprising, because this week we had China, the vice minister there of industry, saying they're looking to ban the sales of internal combustion engines at a point in time. We've got both France and Britain who say there'll be no more sales of internal combustion engines in 2040. So it's coming, and it sounds like a long way away, but in these kind of industries, when you have a massive change in industries, you need to look ahead. But take that basis. The annual production of copper is 20 million tons a year. To get to the amount of copper that will be needed for electric cars in 2035, given the projections of where electric cars or production is going to be, they need to add another 23 million tons to the demand. So the production must go from 20 to 43 million tons. Obviously, that's going to have an impact on the price, because those tons just aren't available. But more exciting, as far as Glencore is concerned, is cobalt, where it's #1 in the world, and the total production of the world right now is 100,000 tons a year. It's going to require, to put these electric cars together, 679,000 tons a year, an extra 679,000. So you're going to have to increase the production of cobalt sevenfold. Now, clearly, that's not possible. So what happens is that the price adjusts accordingly. And that is where you're looking very good if you're a Glencore shareholder, given that they've made these bets long before the rest of the market. Nickel, current production 2 million tons. They're going to be adding another 1.8 million tons just for electric cars. It's a very, very bullish story. And as a consequence of that, and the more people who pick up on this, and you can see it was almost at the time that Glassenberg told the story that the share price started turning around. It now is a play on electric cars, on this seismic shift in the motor vehicle market away from internal combustion engines to electric cars. And it's been a wonderful performer for our portfolio, has Glencore, in the relatively short time that we've had it on there. And just closing off with MTN, my word, there's all kinds of punts or beliefs or views on MTN. I remain very comfortable. We're backing management here. We're backing management who've got investments in Africa and in Iran. We also believe that the team that's running it now is handpicked by Phuthuma Nhleko, and he is the chairman. Is a very, very smart operator. He's the man who transformed MTN from a very poor second behind Vodacom into, well, a more certainly potentially a bigger company or more valuable company. They aren't looking at it at the moment, but it'll get there. And the share price is still trading at a little bit of a discount of where we bought in. But with a new management team all in place now, you can expect interesting things to happen there. And just to close off with, there's the portfolio as it stands. As you can see at the bottom there, MTN down 4%, Investec up 2%, Mediclinic down 4%. Those are the if you like, as you were stocks. But the three big winners, Naspers, Discovery, and Glencore. And then the big loser has been Brait. We're not worried about those winners being overpriced, nor that Brait is going to be falling further. So that's a portfolio that to me is very nicely balanced at the moment. I see Brait is now down to 10% of our portfolio, and Naspers, through its increase and through the additional investment we've made, is now 20% of our portfolio. So that's a nice place to be, and it's almost self-correcting as the companies like Naspers and Discovery outperform. They become a bigger share of the portfolio. Unfortunately, Glencore, we only put 7,500 Rand in because that's what we got from our Wilson Bailey investment, and we just put that, channel that straight back in there. But already it's gone up to 9% of the portfolio. Stu, any last question?
Just one from Len on Glencore. Alec, he just wants to know if you should rather buy Glencore with dollars. I'm not sure if he's just trying to invest offshore rather than on the SA side, but that's his final question from the readers, listeners.
I would be buying it in rands, and the reason why is that your dollars that you happen to have offshore are a lot more valuable, or rather, you've got a far bigger universe to invest in. When you're sitting with rands, your universe is just the JSE. So if you're going to buy the stock, use rands if you have them, and buy it through the JSE, because the price equalizes. It'll give you eventually the dollar price of that the stock will be reflected on the JSE. So there's no problem in doing it that way.
That's it, great. Thanks a lot, Alec.
Well, we've come to the end of our 60 minutes for today. Thank you very much for being with us. The portfolio, as you can see, is lagging behind the JSE All Share Index, but it is in positive territory. So we've taken care of all our costs, and it's up. We put in 100,000 to start with. We're now 106,176, and we're up on where we began, and we are in a position very well, in my opinion, for what we do believe will be a decline of the South African rand in the medium term. That's really what this bet is about. But this is a long-term bet. It's a long-term portfolio, and you can buy it easily and cheaply through easy equities. In fact, for I think it's as little as 500 Rand or 250 Rand, you can get this whole portfolio broken down by them in your Biznews bundle, in the Biznews SA Champions bundle that they offer. I hope you take advantage of that, and I hope to be back with you again next month. Cheers for now.